All right, well, I want to welcome you guys to the Womack Market Update. We've got some attendees still joining in on us here, so want to make sure you guys can hear me. If you can hear me, someone put in a text if you would, I guess. Make sure we get, there's a chat box, should be at the bottom or the top of your screen. If you'd like to tune in to see, let us know if you can hear me or not. Got a couple of chats here. Can hear you fine here. Okay, look, great. All right, well, we'll get started here. We'll probably have a few more join us. We had a pretty good sign up for today, and we'll go ahead and get started. So today we're going to take a look at the market and outlook and the summary of what's gone on since February. And then we've got a special update today because we did have our bull bear indicator turn bearish just last Friday. So as we get more participants coming in, that'll be fine. We've got a couple little quizzes we'll give as well today. So we'll go ahead and get started. Most of you guys know who we are and myself, Greg Womack, and been in business for a number of years and with Womack Investment Advisers since 2000. And let's see here, go on to the next slide. Okay, let's talk about the performance of the markets. You look at these numbers here for February, the market, the S&P was down 8%. And if we go to year to date, as of yesterday, it's down 11.9. NASDAQ down a little bit more, 12% versus an 18% on the year. And the S&P 600, which is your small caps, is down 6% and 9.4% on the year. Commodities up 14.9 in the month of February alone, but year to date up 32.8. So you can see this has been kind of the inflationary theme, the commodities, whether it's agriculture, energy, metals, industrial metals, etc. And speaking of metals or materials and commodities, February we had U.S. oil up 24.4%, year to date 51.5%. Energy sector, which is your energy stocks, was up 27.2%, year to date 37.6%. Material stocks down for February and for the year about 11.5%. Gold up 4.3 in February, year to date 9.3. So you're seeing commodities in general really boosting and outperforming the general market. And we'll get more into supply and demand and the inflation issue in just a minute. But so what we're seeing is the fear and the greed index, which is measured daily, weekly, monthly, and yearly, can be used to gauge whether the market is fairly priced. Excuse me. And this is based on logic that excessive fear tends to drive down share prices, and too much greed tends to have the opposite effect. So, investors are driven by two emotions, basically, fear and greed. And so too much fear can sink stocks well below where they should be. And when investors get greedy, they can also bid them up way too high. So we're seeing extreme fear right now. I think that's, basically, what we saw last time was a little bit more of a moderate in that 50 range. But, since we've had this major pullback in the market, stocks have moved lower and the fear index has grown higher as well. So what we're looking at, last month was a 35 here. So basically, we're going to have extreme fear levels for a while for stocks to become cheaper. And we'll be talking more about that when it comes to the bull and the bear. This is also showing the number of stocks hitting 52-week lows that exceeds the number of hitting highs. And it's at the lower end of its range, and indicating, of course, extreme fear. And this was last changed January 20th from a fear rating. So this is the Volatility Index called the VIX, and this is kind of the 50-day moving average, and is at 3607. which was last changed on February 25th from a neutral rating. So what we're seeing now naturally is a decline in the market. So I've got the first poll for us. Let's take a poll here. I'll launch this poll here. And the first one is, are you currently bullish or bearish on the markets? So choose one or the other, and we'll see how everybody's feeling. Okay, so far, back and forth. Looks like the bears are possibly going to win out the day. We'll keep that up for another 10 seconds here. If anybody wants to vote, make sure that you did vote or choose your option there. Okay, looks like the bears have won this particular poll. Okay, now it's 63% versus 38. Okay, so we're going to end the poll. That kind of gives us a feel. Some of you are bullish, but most of you are bearish. And here's the results of that. Okay. So we're going to close that poll and go to the next slide here. So now I kept this up because, what could kill the bull market for stocks? Because, we talked about previously that the economy could weaken, which higher inflation could cause that down the road, higher energy prices, continued higher inflation, which would, your supply chains disruptions, supply and demand issues, geopolitical fallout, which we're kind of seeing some of that right now, but also a black swan event. Now, what could be a black swan event? It's something that's going to blindside the market. So that could cause additional blows to the markets. For example, if we had some type of cyber attack on our banking system or the internet or the grid, electrical grid. So these are things that we can't control. But so if we continue to have this higher inflation, higher energy prices, it's going to be harder for the economy to continue to improve at the current past rate it has. So here's the inflation rates. Most of the inflation, they have it pegged at around 7%. The red is the CPI numbers, Consumer Inflation Index, CPI. The alternative is in the blue, and that's based through shadowstats.com. That's a gentleman who used to work for the Economic Advisor Board for the government, and he's figuring it the way they used to figure it without watering it down, and he's got it pegged at over 15% currently. So we are seeing higher inflation. And I remember several months ago when we started seeing inflation pick up, it didn't look to be transitory, and we called it then, and we're seeing this play out in our markets today in the economy. Now I want to take a look at this chart. This is the chart of the 121-year view of the U.S. stock market. So it clearly shows that the market benefits from multi-year periods of what we call dramatically rising prices, called bull markets, followed by multi-year periods during which the market suffers big hits and goes nowhere overall. So these are called secular bear markets. And so that's in the red here. And basically what happens is in the secular bull markets, demand is clearly and conspicuously in control, whereas secular bear markets, supply and demand fight a seesaw battle with each other and gaining the upper hand for periods of time. So during a secular bear market, it is very difficult for a buy and hold investor to do well. So that's at periods in the red here that you see in this areas here. So what you see is the price earnings, which is your CAPE long-term PE ratio. You see the price earnings come down typically below 10 before the next bull market. As you can see, then price valuations go higher as prices increase. So here we are currently, and we're in this CAPE range now. It used to be in the 39 range, 40 range. Now it's at right around 35. And so we're still kind of in that high area where it's difficult, say over in the next 10 years, to be a buy hold investor and make money in the market. Okay, so this here shows us that if you're starting your PE ratio in this range here, which we're in that 35 to 40 range. This says that any 10-year period looking forward, when you're starting that PE here, is that your 10-year projected rate of return is flat to down if we're starting in this range. Now, that here again, that's buy and hold. So in this market, you don't want to be a buy and hold investor. You want to be nimble. You want to be particular about what you buy and own, and you can still make money in a bear market. It's just difficult to do it if you're a buy and hold investor. So, and we base this on what we call fact-based. So for months now, people, thinking we're in a bear market, the market's been in a correction, and many times you see the market continue to move higher. And so what we wait on is the facts. What is the market telling us? And it's all about supply and demand. So fact-based investing, we zero in on measurements that reflect that continuous tug of war between supply and demand. We believe that every single tick in the market and every trend results from imbalances from supply and demand. So after all, if there were no imbalance of supply and demand, prices wouldn't budge at all. And longer running trends are, in our view, driven by longer term imbalances of this supply and demand. So when you implement a fact-based strategy, we don't make market predictions. We don't require that markets or investors be rational or efficient, and we don't remain fully invested regardless of the market circumstances. So how do we do that? Well, one is we focus on what is a market supply and demand, and rejects what might be, what could happen. So and so on TV says, this, and I'm reading this, and Uncle Joe says this, and, and all these prediction-based investing and what ought to be of a theory. So we don't really focus on that. What we look at is the facts. And so here today, I want to share with you our bull bear indicator. And this bull bear indicator, for those of you who have not seen this yet, many of our clients have, but this top part here is the indicator. And think of it as an EKG. So this line is an EKG that goes up and down. And this green line you see right here at 55, that says if the stocks move, if this line moves above that and stays above the green, red, once it moves above the green, then we are in a bull market. And the market could go down. As long as it stays above the red, it's fine. Like it did during this period right here, it stayed above the red during this bull market we saw here. So this bottom part is the S&P. So what this means is if it drops below 45, that means that there's not enough demand in the market for the markets to continue to move higher. Not enough demand to pick up the supply that's being sold. Okay, so becomes a slack of that demand, and the supply grows, and therefore prices go down. So we saw that back here in October of 2000, right here in October, it did. So we saw the market go down a period of almost 2.5 years, 50+% down. And then it bottomed out when it went up through this green line here on March, right here. It bottomed out, and then the market moved higher. So there's been a couple of 2 or 3 bear markets along the way. We've got one here that lasted about 1.5 years. Here's just about 4 to 6 months. Here's about a 6-month one, 6 to 8 months here in January of 2016. So we have not had a bear market indicator or turn bearish since January 2016, but now we have. March of 2022, March 4th, excuse me. So just this last Friday. So it touched that. It's down probably around 40 right now. It hit 45 on last Friday, and it has to close on a Friday below 45 or lower. So we're at about a 40 right now. So we'd probably somewhere in there. So What does that mean? Well, it means that it's going to be difficult for a buy and hold investor to make money in the market. Doesn't mean all stocks are going to go down, but in general, if we get into a major downturn like we did, say, in 2000, the tech crash bubble here, and then in 2008, the mortgage crisis, those were significantly 50% declines in the market. So we don't know if it's going to be a short-term bear market like it was in 2012 and 2016, or is this the beginning of another huge leg down at some point? And they typically don't happen all at once. It could be over a period of 6 months to a year, 2 years, or longer, possibly. It's hard to say. But all that said, we want to be prepared. So what are we doing? We're actually being selective and raising cash right now in our models and our portfolios of our clients. And I'll talk more about what we're owning here in just a minute, but we're being selective and we're using this, and we will not go back 100% into the market until this hits the green area. And like I said, that could be months or it could be a year, who knows how long it will be. Okay, so by the way, if you do have some questions, feel free to chat and send those in, and I'll try to catch up on those here before we close today. Okay, next slide here. Bonds, bonds typically have been a diversifier for stocks. Typically, you say you get a 60-40% portfolio, 60% bonds, 40 or stocks, 40% bonds. You got a good balanced portfolio. Well, bonds have been in a bear market since October of last year, and you can see here it's they've moved off their highs. Interest rates. Why are we in a bear market in bonds? Because interest rates have moved higher and bond prices have moved lower. So bonds have not been that traditional safe haven as much, where you can still make 3 to 4, 5, 6% on that money while the stocks are more volatile. And so typically you see that, but not in this condition we're in today in the economy. Resources, materials are still in a bull market. Bull market meaning charging ahead versus a bear market meaning clawing downward or hibernating. And so what we're seeing here is material stocks, whether it's chemicals, metals, industrial, rubber, things of plastics, etc. Those material stocks are still doing high demand right now. Real estate has weakened. It has not reached the bear status yet, but it has weakened here. So time will tell if the higher interest rates and higher inflation is going to put a crimp on the real estate market. And this is particularly not your residential areas as much as it is more your real estate investment trusts and office and other types of industrial office real estate. Now, so I mentioned gold earlier, how well it's done this year. Well, we've here at Womack Investment Advisers, we have always owned 10 to 20% of our clients' monies in gold or precious metals. Because of all the money printing and all the debt and the trillions of dollars that has been going on, kind of the phony money stuff that we're in our currency, gold is something that should be a part of a core portfolio long term. Some of our clients own more than 20% because they want to, but we encourage you to own at least 10 to 20%. So we do here at our firm, we buy some gold exchange traded funds that particularly are linked to the price of gold. So gold moves higher, the ETF moves higher, silver, etc. And so right now we see really good, still good values on those compared to the general market. They've underperformed over the last 5 years or so. So we still like gold and precious metals. Gold is a store value. It's a reserve currency of the world, really. I mean, they say the dollar is, but gold, the central banks around the world have accumulated tons and tons of gold the last number of years to help protect against their currency. And so owning both gold, you can own it physically you know, I encourage some gold, perhaps coins is good to own because they are minted, U.S. minted coins. Get those. You can store those in a safe place in your home and with easy access to them if you need to exchange them at some point. Silver the same way. And then also gold stocks. These are mining companies. And I just got back from Fort Lauderdale last week from a big gold stock mining conference, one of our research firms, and some of the top gold companies and silver companies in the world were there speaking, the presidents of their companies. Very bullish on the metals right now and have been for a number of years, actually. So you want to own some gold in the portfolio, and this can act as an insurance or a hedge in the event of a total meltdown, and we're seeing it do good now, even though there's not a total meltdown. It's just because the inflation issue and the uncertainty that's going on in the world. Our strength indicator for gold, it has been positive since May of 2021. It kind of had a little blip back before that, February of 21, then went positive again. But here again, so the trends are still up on gold. And if you look at gold prices compared to the US dollar, and look how gold prices kind of in that yellow orange here, and how it will typically move up and the dollar typically move down, and vice versa. So you see the movement here of this inverse relationship. And over this 10-year period, gold has still outperformed the dollar, even at a little over 1,800 an ounce. Now we're looking at close to 2,000 today, a little bit over $2,000 an ounce today. So this was a month or so ago that gold was just right at 1,800. Energy, as I mentioned, this is the XLE ETF. This tracks a lot of your top oil and gas producers in the business. And so it's been positive since May of last year as well. This has been a huge benefactor of higher oil crude prices. And speaking of crude, let's talk about Russia, since that's on probably everybody's mind. So it's well known that Russia is probably one of the world's largest producers of energy, both natural gas and oil. So as gas prices continue to hit new highs across the country, just how much of the world's oil does Russia produce? Well, data from the U.S. Energy Information Administration shows that Russia is currently third in the world in daily production of Brent crude oil, with 11% of the total. So the USA does lead with 20%, and Saudi Arabia is second at 12%. Interestingly enough, though, Russia's Urals grade oil is now trading at an $18 per barrel discount to Brent, because buyers are bypassing Russian oil in favor of other exporters. We'll see how long this lasts. I know there's a lot of strong feelings about what's going on in Russia and Ukraine. I think there's more than what we're being told from the news media. There's probably more going on there. We knew that Ukraine has been a deep state, what do you want to call it? Basically money laundering, very corrupt government. And so we don't really know what's going on there, but we do know that it's causing some issues when it comes to the energy, of course, disruption. And we do think of our fellow humans and there in Ukraine, the displacement that they are having. But what I would say, this too will pass. So we'll just have to see how things go with the oil situation, but we probably can expect in the midterm or near term continued higher energy prices. At some point, there could be some big announcements of releasing huge oil reserves, strategic reserves that could cause oil prices to come down some. But I think still we have a ways to go. So what I want to talk about today is some of the sectors to invest in today, perhaps for the near term. And as I mentioned, oil and gas stocks. Both you have exploration stocks that are doing well. You've got oil and gas service stocks, which you can get through the XLE, et cetera. And we do own those in our portfolio model, by the way. And then there's transportation and storage, huge demand for those. also refinery. And so those stocks, some of those, particularly the oil and gas pipeline, have not made the big moves like your producers have. And think companies, that like master limited partnerships that are doing transportation or storage, that pay huge dividends or pay huge payouts on these, are probably a good place to be as well. So diversify your oil and gas positions. Also like metals, as I mentioned, both industrial, whether it's copper related, lithium, etc., precious metals, gold, silver, platinum, perhaps, and also the mining stocks. Those tend to do much better than the underlying asset when there's a bull market in those areas. Commodity stocks, which you got agriculture, of course, energy, basic materials. Defense stocks are actually doing well. That's been a big sector of ours for many years. We're finally starting to see some rise in the defense stock areas, as you can imagine. So not only do we have Russia and Ukraine that could continue to boost these stocks, we also, the next stage, our next theater stage will be probably China and Taiwan. So more to look forward to there. Another area is utilities. People need utilities to live, heat, air, electricity. And so utilities are kind of a defensive position. So during times like these, utilities could outperform the general market. And of course, cash. We've raised some cash here just recently, and we're going to kind of keep that dry powder in a bear market. Considered a bear market, it's good to have some dry powder as well. And just to be patient, to build that list. So we'll be a building list of maybe some of the tech companies and other companies that maybe are suffering right now, but at some point it's going to be a very good bargain. And when we turn from a bear to a bull, then we'll want to take advantage of those, and you need some dry cash or to reallocate. Okay, so any questions we have here? Let's take a poll. See if I can release this poll here. Okay, next poll. Well, I don't know if I can release this poll or not, but I'm working on it here. Let's see. I don't think that one is able to release. So I'll stop sharing that. So, but what do you think is going to happen? Do you want to send in a text? You can do that right now. How do you think the markets are going to end up in 2022 for the S&P 500? One, do you think it's going to be up strong? Perhaps we're going to go through a downturn, and then at some point we rally up and end up the year strong, or up slightly, perhaps down to flat, or down big. What do you think we're going to end up? And if you wouldn't mind just sending it in your chat. Okay. We got some saying up slightly. Okay. So several saying up slightly. So interesting times, right? So one of the things we want to do is, what are your concerns that you might have in your portfolio? Are you nearing retirement or in retirement and you're concerned about things and you want to visit? Give us a call. Email us or give us a call. We'll get you on the calendar to discuss maybe any concern that you might have. And then also, what we want to do is, if you aren't a client and you would like a review of your portfolio to help maybe identify some laggards and suggestions for adding strength, look at ways to be prepared for the worst if things continue to get worse from this point. So there is a survey if you want to complete after the webinar, so we complete that survey, and then we can get that and give you a call back and see if we can be of help to you. I will now just kind of open it up for any questions through chat if you guys want to. So B would like a copy of the slides. Yes, sir. You can. We'll send those out to you, those who attended today. Any other questions before we kind of wrap things up? Just if you don't mind typing in your question there. or if you raise your hand, I can actually allow you to say something. How's that? Okay. Well, I want to thank you for attending. Like I said, this is not a time to panic. I think we're taking some steps to in our portfolio management process to help raise some cash and be prepared and be invested in some of those areas that we just discussed. And let us know if you've got any questions, and we thank you for your time. And if you want a copy of these slides, just shoot us an email. And actually, we'll go ahead and send them out to you as well. So thank you for attending. We'll see you next time.